Welcome for the second session. My name is Christoph Wenk. I'm a partner at Swipro Services and a trusted board advisors. And I also have see my academic hat on. I'm a program manager at the University of Zurich, where we do a CAS and stakeholder management with a course for investor relations. But that's enough. Now let's dive into the topic of this afternoon, the Trump effect. I will focus on Switzerland, and I guess many of us, if you think of that topic, that basically comes to your mind, right? The US president basically ripping apart everything that is related to ESG, which we are not allowed to say anymore. But, what has happened in the US and what is actually happening in Switzerland? And, is there any spillover? And that's what I want to kind of go through quickly with you. But to kind of understand it, let's just first have a very quick look of why actually something should happen in Switzerland. So in the US, we've seen they've made it much more stringent for shareholder proposals. You have to narrow the scope. You have to kind of show financial materiality. So you have to kind of higher burden of proof. You're not allowed anymore to micromanage a company. So it really has to be on the strategic and not the operational level. And there's also higher hurdles for proxy advisors. So these are kind of rules that are currently in deliberations. We don't know how they will turn out, but it's for sure that proxy advisors will, for now, keep their heads low to not be targeted with stricter rules, because that would significantly impact their business model. And then we have this executive order 14173 that basically killed DEI. So there is stuff we observed in the US. We've seen guidelines, proxy guidelines from BlackRock, for example, that significantly kind of reduced the amount of diversity. So if you look at last year's guideline, it was 8 times diversity. This year, it's just once in there. So, and it's their EMEA guideline, right? It's not the US guideline. So it seems that there is some impact on the larger shareholders, institutional shareholders. And ISS, they basically pulled it out of their analysis altogether, but this is only for the US. So there is a softening of tone, fewer, lower expectations from the US. And there was an effect, obviously, in the US. You've seen the reduction in shareholder proposals. We've seen an increase in no action at the US. So many more of these shareholder proposals have been submitted to the SEC, asking for not allowing them to go on the ballot because they were inappropriate, because they were out of scope, micromanaging, or the reasons I mentioned before. Interestingly, maybe is that it's not a general development we've seen. Governance proposals have pretty much remained at the same level. So definitely, there is an impact in the US, but why should we care in Switzerland, and why could it be an impact for us? So as as Nick showed before, we have significant foreign investments in Swiss companies, especially in the largest ones. Many of them come from the US. And we've seen the proxy advisors increasingly, under scrutiny from the US. So there's definitely reason to, suggest that we may see something in Switzerland too. And especially when you look at the media, it seems that, ESG is that all around the world. But in Switzerland, what we do have, the regulator has mandated the vote on the sustainability report. The regulator has mandated a minimum representation of female board members. So, whatever the US says, we do have our own regulation, and some of that is probably, cannot be ignored by the shareholders. So it's basically, which is actually holding stronger. But if anything is happening in Switzerland, we would expect it to be shown in the vote on the sustainability report and the board diversity votes. So, do we have sufficient female representation on the board? And obviously support for ESG shareholder proposals. However, we have had very few of them in Switzerland, and I at least have not come across one this year. So, what has happened? We will start with the sustainability report. And if we average, our sample is always we call it the SPI 100, so it's the 100 largest companies from the Swiss Performance Index. And if you would look overall, you will see an increase from about 4.5% against votes to 6.5% against votes, roughly. So these votes are all free float votes. So we exclude family ownership, we exclude ownership of large family offices or also founders. And that's why they're probably a bit higher than you would observe directly on the market. Interestingly, you can see that it's mainly driven by non-SMI companies, so the smaller ones. The larger ones, most of them have been starting to prepare or have been preparing to publish the CSRD reports. So they have done quite a lot of work, and that's probably why you see a decrease for them. But the non-SMI companies definitely have seen an increase in shareholder negative votes or against votes. So that is kind of a first argument to show that no, we don't see the Trump effect here in the sustainability report votes because the against votes actually increase, but we would have expected them to decrease, right? When we look closer, we can see that this decrease, or this increase in against votes is mainly driven by Swiss investors, Swiss proxy advisors, some European investors too. The low level, why we're still kind of at this very low level of against votes, I think is pretty much to the right side, where you can see if you have a vote on a sustainability report, which is fairly broad, so we have everything in there, from basic information to maybe some information on your targets, on your plan to kind of lower your emissions. And so it's really kind of a one size fits all, and many investors treat it as more as a, they have this report that's okay, but not on the ambition of the report. So if you look at the UK and Europe, what you can see clearly is the difference. Sustainability reports generally get a high level of support because it's really just kind of a, you need to do that. It's a compliance exercise. It's okay. It's done. But if you become more specific, for example, you go for a transition plan, shareholders become more critical. And I think that's the reason why in Switzerland, because we have this very general vote, the level of approval is fairly high. But when you go back to Trump, I think the effect is non-existent here. However, we don't know the counterfactual. So maybe without Trump, we would have seen even more critical votes. Can't be sure here. When we look at gender, that's also an interesting one. On the left side, the cake pie, we looked at the 100 most critical votes, so the votes that had the highest fraction of against votes. And we looked at what were the reasons, why were these board members voted with such a low approval rate. And here we see a quarter of these 100 elections, a reason was diversity. And that has increased quite a bit. Last year it was around 10, 11%. Now it's a quarter of the elections. So definitely diversity is still an issue for shareholders. Here in Switzerland it's mainly the gender diversity. In the middle, what you can see is the election of the nomination committee chair. So we looked at who in the board is sitting at the chair of the nomination committee, and how have these guys received or been voted in. And when you are the nomination committee chair of a company with less than 30% female representation on the board, you generally get an against vote of almost 19%. Your peers that have sufficient diversity on the board only get 6%. So you clearly can see that it is a reason for investors to vote against you if you don't kind of have this minimum diversity level on the board. And likewise, on the right hand side, what you can see here is really that, again, this year, the representation of females on the board of directors of the largest 100 Swiss companies has increased. Interestingly, the smaller ones have now caught up to the SMI companies. Used to be kind of a big gap over the last couple of years, but that gap has been closed. So it's the smaller and medium-sized companies that have caught up. So also here, with respect to diversity, I would not see any impact of Trump on the Swiss market, or not on the Swiss market, on the AGM season 2025. And then maybe some secondary observations also related to that. When we looked at compensation systems of Swiss companies, how many sustainability KPIs were in there. We've seen again an increase from 67 to 76%. So more companies have actually included a sustainability KPI in their compensation, and generally these KPIs have become more transparent. So in past years, we've seen many of these KPIs in there, but you had no idea what they were about, so that has changed too. So it's more transparency in there too. And we've also seen more and more companies now, especially TCFD is now basically almost 100% of the SPI 100 is using a TCFD report. This is obviously also related to the regulatory requirements. But generally, companies use more of these sustainability reporting frameworks, which is, again, I guess, a reason that Trump did not have an effect on the Swiss companies too. However, kind of caveat here is companies have started to prepare their reports by the end of 2024. So it's not clear whether or not we would expect actually an impact on the reporting, because it was kind of early in the year, but was it early enough? We don't really know. At least from what we've seen here, it doesn't seem to suggest we do have seen an impact. Now, so summing up, what is the Trump effect? I think, contrary to the US, I think we really have a very little, small, tiny effect in Switzerland. Again, we don't know the counterfactual, but I think it's almost negligible. Swiss and European shareholders continued their voting on sustainability as well as board diversity. Yeah, I think maybe what had a bigger impact than Trump is really the stop clock from the EU. So the pressure that kind of came down a bit on the sustainability reporting. So companies will continue to do all the sustainability reporting, but it's maybe a bit of a slower pace than we used to see in the past. Generally, I think what we should learn or take away from that is really that companies and their decision makers, you should definitely listen to your shareholders. Shareholders are, one of your key stakeholders. But in the end, you need to take the decision that is best for the company and not the one that is basically told you by your shareholders. Right? You need to kind of balance, you need to take this input, but in the end, the decision that your board or your management should take is something that is informed by shareholders, but may not basically kind of delivered by your shareholders. Great. And I think with that, I'm done. I do hope that I have been able to show you a little bit of different channels that could have been subject to a Trump effect, but which we did not believe or observed, at least at this AGM season, to have had an effect of Trump. Should we take any questions now, or do we? Afterwards, we do it in the panel. All right. Thank you very much.
Good afternoon, everyone, and thanks for making time for me. I've been asked to sort of give you a sense of what we've seen in the AGM season. Just to give you some background, I'm both a US citizen and a French citizen, and I've been running the DF King business for 10 years, and I see a lot of corporate actions. I've seen over $1 trillion in deal value on M&A in Europe in the last 10 years. I've worked on several defenses across Europe, and also have run many corporate governance roadshows. So I've tried to present this in a way that's much more what I observe and what I see when I'm trying to solve problems for clients in real life situations. So it's a little less about the statistics and more about what we see when we act. My general observations about the AGM season, and I've been doing this for 20 years, is that generally it's fair to say that companies have real mastery of corporate governance issues that are key at AGMs. Corporate governance engagement between boards and investors is a well-established thing that's occurred for more than a decade in most developed European economies. I think as well, and this is a very big difference than in the United States, there's business consensus in Europe about how that to to try to improve corporate governance in meaningful ways. You see this in some form of binding decisions on key topics. Take the example of France. Both remuneration policies and remuneration reports are binding, which is very different than when your report is not binding. In the United States, essentially the boards can decide to listen to their investors and not apply their voting actions. There's also continuous improvement on governance, but also environmental and societal issues. If one were to sort of take the paradigm of the 2016 Paris Accords as a milestone around which many companies worked with local legislations in Europe to develop a wider ESG worldview to start to take on meaningful, measurable environmental and societal issues over time, one saw progress. And what was interesting was that the companies were actively promoting and helping to see this crystallize. And then I think otherwise that sort of lends to the other sense around that companies in Europe do have a real understanding that while the shareholder is tantamount to everything else, that there are other stakeholders they need to take into consideration. My conviction about AGM success is transparency. If your company is transparent about what it's doing and why it's doing it and how it does it, usually they will get to yes, and they will have been able to federate both internally on these topics and also to be able to give clear explanations of the decisions and their direction of travel on the big subjects. It's much harder to get something approved if you don't give any color on your criteria on a remuneration package, or you don't spell out the skill set of your board members, or you don't explain why you need this capital increase. And then when we think about ESG, I think investors' demands on ESG topics have grown over time, but their core focus, whatever the investment style, remains a little bit more nuanced. They need to understand that your company can deliver on the strategy over time. They need to see improvement on operational performance. They need to really have a real sense that you can generate shareholder value over time. And other thing I'd say in preparation for this, I spoke to a lot of investors, and one thing that came across was that they were saying, as a minority investor, we're losing patience with companies' refusal to listen to their expectations over a medium term around policy. And if you think that the E and the S are shrinking a bit in terms of their remit, they're going to demonstrate their bona fides on G. I won't go into the details of this, but often one of the key issues that every company faces is, how do I tell the story about my remuneration policy and then the report? And what I would just say on these slides is, if you think about remuneration as a storytelling opportunity, where you're explaining what goals you have in relation to this policy to attract the best and brightest to deliver the strategy of your company that will deliver value for your investors, it's usually the right approach. So when we work with companies, we try to help them understand and how to explain these kind of topics in a pretty straightforward way. And then if you think about the report, it's much more about getting to yes. Okay, so why should this individual be paid so much money? And the best way to be able to demonstrate that is show that it was hard to do, that they delivered where they were supposed to, and that created a great deal of value. Often, it's important to demonstrate alignment between performance and payout. Make sure it's easy for your investors to quickly understand how your remuneration works and how people get paid. Never forget that even the largest investors have limited teams. And if they have to look at 5,000 AGMs, of which 2/3 occur between late March and early July, if you don't make it easy for them, it's going to be harder for them to look at the detail and give you an exception or understand the alignment. And ultimately, around quantum, sense check it, make sure nothing appears to be guaranteed money, and avoid any risk of being accused of pay for failure. The other internal challenges I think that you face are around elections and governance. And what we noticed this year is that board elections were harder to get through if people were overboarded, because investors are just fed up with having to give exceptions to what they think is the right thing to do. Really important that they understand the skill set and the gravitas and that it's in line with your company's current needs, that they can effectively challenge the general management around the strategy and their ability to implement it. One of the most straightforward plays on an activist event would be to judge the independent board director's ability to challenge the management. And if they're not doing it, it's easier to replace them. So these are things just to bear in mind, and I think that independent members need to demonstrate that they are impactful. The other thing that has become harder are sort of sticky governance topics. Intercompany agreements that are opaque or lack clear explanations are harder and harder to get support from your investors if you cannot explain what they mean and their interest to your investors of these structures. I think as well, far less of a problem here, but I do a lot of work with French groups, and combined chairs and CEOs do regularly meet a certain amount of resistance, and it's important to be able to explain that. And then if you have multiple voting rights, investors don't like that, and they're pushing even harder today. Thinking about the changes in the US voting landscape since January. So trying to understand this, I looked at what we were doing with our clients, and I also spoke with one proxy advisor. I asked for two, only one would take the meeting. But I also spoke with a leading European and a leading American bulge bracket investor about how they have seen and perceived any change, along with what I've experienced with the clients we work with. So if we think about US behavior relating to European investments, the largest investment managers from outside the US, if we think of them, they have more leeway about voting, and they also have obligations to adhere to your local laws. So it wouldn't be a thing that they might not talk about. They never talked about DEI really in Europe. They talked about gender diversity. They talked about ESG. They talked about carbon neutrality. So it's a little different. So they've just sort of maybe changed the rules or the language. In terms of the engagement, the first thing that sort of happened in February was changes in Section 13D and 13G that modified how shareholder engagement occurred if you were an American investor with more than 5% in an American company. But initially, there were reactions from the big three passive investors, but that quickly settled down. And let's just say that most of these passive investors took the meetings with companies and had meaningful discussions. The format was different. They might have focused more on G and more on the company and less on E and S. And really, when I was speaking to these investors, what they said to me was it was a year where we had to demonstrate our governance bona fides and practically make it harder to, because it's harder to attack those than, say, E and S in this current environment. Sometimes the passive investors may go into listening mode, but they remain impactful. And then I just say, clearly, European investors are still generally fully committed to their ESG goals. In terms of voting, there's a lower tolerance for supporting pay structures that were poorly designed and reward poor performance, overboarding, far greater difficulty to get those approved. And there's not a lot of room for exceptions. You can get them, but it's harder. And then I'd also say U.S. proxy advisors, as Christoph has mentioned, are under a tremendous amount of pressure in the United States. In Europe, it's much more nuanced. Essentially, the proxies have their own local policies for most developed countries, so they're going to look at it from your situation. And if you do get negative recommendations, companies have to lobby harder internally to give you an exception. And that there's a sense that given the pressure on E and S, investors might be less willing to give you the exception because they have to demonstrate at least on G they exist. And the only real way to get around it is give compelling arguments and be transparent. So that was kind of just the overview of what I've seen. And I know that we want to go to go into the Q&A and sort of go into detail about that. But thanks so much for listening.
Yeah, okay. Watch my hand here.
So thanks to both of you for those insights. Speaking of proxy strategies, just to both of you, the question, are European and also Swiss companies adjusting their proxy strategies in response to these evolving expectations from US institutional investors? That's around ESG, board accountability, and also compensation, obviously. Maybe David.
Yeah, sure.
Right
So,
away.
I mean, in terms of ESG, there was movement before 2024. I think the high water mark of the all-in ESG moment was 2021 to 2022. But by mid-year 2022, you started to see pushback. There was a series of articles in The Economist in July of 2022 that questioned some of the overreach on governance. So there was this sense that maybe you had to have more meat on the bone, if you will, and not everybody. I mean, the sense I always had was that corporates really managed the ESG and they actually were the experts, far better than the ratings agencies and far better than the investors because they were implementing it. And when I think about E, what's happened is effectively that some frustrations earlier on crystallized into this anti-woke, for lack of a better term, movement that swept Trump into power. And effectively, they've confused a lot of things. And so what we've seen with the Europeans, they've had to sort of face off with the E and sort of say, we still believe in it, we're maybe going to be changing it, but we know how to do this. We know how to do this for real, and we might have been doing it for over a decade, and we're on our path to carbon neutrality, and we're just maybe not going to talk a lot about it as much, but we're still going to go forward. And in the US, it's quite different because it's become sort of an accusation that investors outsourced their decision making to third parties, which really isn't what happened. In terms of S, which in the US is DEI, my sense is investors are taking a more pragmatic approach. And they're, in terms of their engagement and voting on these subjects, clearly in the US, because of the legal changes, in the US, they're toning down or renouncing on gender ethnic considerations on their voting recommendations. But I'd say that non-US clients, when the proxy advisors, they may not have changed their policies as much. And then I'd say that if when you think about American investors, you have to think of what they're doing in the United States and what they're doing in Europe. So in Europe, they're usually making decisions physically outside the United States, and they have to look at these questions from both their overall policy, but the rules that are local. So if the requirement since 2017 is to have 40% gender diversity on a French board, that's not going to change. If you have to have a non-financial accountant, because it's the French law, to talk about ESG issues, that's not going to change, kind of thing. And then I just think that it's more of a change of vocabulary, and a lot of companies need to keep what they're doing without really, you don't water it down too much, but I think that what this all means is that G has become far more important because they can still talk to you about G. They have policies that are far less controversial. And where you need to focus is if you know that you have remuneration questions out there and you're seeing in the proxy advisory reports and your investors are telling you during your roadshows that they don't like certain things and they've said it to you 3 times in the past 4 years and you're not making the changes, they're probably just going to put the kibosh down and say, you know what, no. And I'm not going to go to committee when ISS recommends against you because it's just too much trouble. But I'll sort of stop there. I know that Chris, you had some things
I think
to add.
I couldn't agree more. I think you said much of the things that I would also observe. I think we really have this decoupling between how an investment house would look at the US and how they would look at European or Swiss companies. The large one historically already had different teams, but I think that's probably now even more so that they have a US policy and then they have a European or a Swiss policy. That's just because this divergence has become so big. The other point I would maybe tuck on a bit is the board accountability. And that's definitely something that we've seen more and more in the AGM seasons, in the sense that, as I've shown before, nomination committee chairs, if shareholders aren't happy with that, they will go after nomination committee chair if there's not 30% female representation. If they're not happy with your compensation, they will go after the compensation committee chair. And what we've seen is this escalation. The investors call it escalation strategy. It has to be part of every voting strategy of the large shareholders. They increasingly use this escalation strategy. So if they come up to you, as David said, with an issue, if you don't react, next year they will just, if they don't like your compensation report, next year they will also go after your compensation committee, and so on, or committee chair, and then the third year they will maybe go after your full committee. And this escalation is something we've seen much more in the last 4 years than maybe in the years up to 2020. And so I think for boards that really means you can't stick your head in the sand and just wait it out, because shareholders will not tolerate that. In the past, they may have just forgotten what happened last year, but no longer, right? They will really kind of level up the game. So we really have to take whatever they say seriously and address that in the engagements.
Okay, thank you. As also for the influence of these proxy advisors, what role what bigger role do these proxy advisors play in shaping the ultimate vote and outcomes? Has their influence increased, decreased, or simply evolved over the years? David, you want to go?
Sure. So the first thing to remember is proxy advisors make recommendations to their clients. Their clients are investors. The investors vote. Think about it maybe this way. It's a recommendation. If you know them better, i.e. your investors, then they will start to listen to you more. And they'll try to understand your point of view, and they will be more willing to make an exception. And sort of what we sort of sense in terms of the evolution is that the first thing is, if you're transparent, clear, objective, and logical in the rationale of your choices, things become a lot easier. The advisor's influence to me has evolved, but I think that they are open to things like a convincing argument on your board choices. They really want to understand how you took a decision and why it makes sense. But they have become more hardline on core governance subjects. They don't want overboarding. They're not going to ever say yes to it. They don't want combined roles. They're never going to say yes. That doesn't mean you can't get it approved, but you're going to have to build up a series of arguments and lobby actively your investors over time so that they essentially can say, I got 3 to 4 conversations in one form or another before I made my decision. Ultimately, I think that the board's view is worthy of my consideration, and I will ask and make and get an exception. And that's kind of how we do it. I mean, that's sort of the sense. But just bear in mind right now, if you're a leading European investment house and you've spent the last 15 years talking about ESG investment and sustainable investment, and a lot of your money was being made in the United States, and over the last 4 years, all the southern states and now the federal government have said, you know what, that's bogus, that's illegal, and I'm going to sue you if you keep this up. The only thing they can still hold their hat up on is governance. So it's going to be harder to get around that.
No, that's a good point. I want to pick up on that in the sense, proxy advisors, they have to provide the same recommendations for 16,000 stocks. So they really have to have the fixed set of rules. They can't deviate. Even if you provide them with a good reason, why this board member should now have dual mandate, they have to fix rules when everyone is expecting them to treat every company the same. But your shareholders, they can deviate. If you're able to provide them a good and substantial reason, they can deviate. But they will hold you accountable the next year. If you tell them, well, we have this dual mandate because, doesn't that happen? Next year they will ask you, so have you progressed on that? So you can deviate, but the proxy advisors, at least in our analysis of the Swiss market, it's pretty much, depends a bit on a topic, but what we've kind of approximated is that amongst your free float shareholders, ISS is moving approximately 20%, Glass Lewis and Ethos around 10%, but that's just the free float shareholders, obviously. But we've also, find results in the Swiss market, and they're, I guess, pretty consistent with what you just said, that even if you have an ISS against vote, recommendation, an against recommendation, you can have a fairly low against turnout from your shareholders. Why is that? Because you probably at that moment have spoken to many of your large shareholders and been able to convince them that they should not go with ISS, but with your reasoning. And we do have data on that. It's also something in the AGM analysis.
And speaking also about AGM, maybe we can look at quickly a bit at the AGM voting patterns in Switzerland, and then we can compare that with other the European market. Do you see, now that you've seen each other's presentations, big differences in shareholder behavior, or at least also in shareholder engagement intensity,
Let's see. I mean, my sense is that I just believe that European corporates do a really good job at this. And when they don't do certain things, they do it on purpose because they know internally it's a battle they can't win, or they might have a limited float. They might be the only listed company in their sector. So there's a legitimate reason not to be the best student. My sense in Switzerland, I'll let you speak to Switzerland, and I can maybe compare to what I see elsewhere. But yeah, I mean.
Oh, should I start?
Yeah. Yeah.
Well, in Switzerland, what we've seen, at least with respect to engagement, is that it started all off with the largest companies, the SMI companies. They started to engage more and more intensely, and with engagements, I really mean that the board of directors is reaching out to the stewardship teams. This is not your financial analyst engagement, but really kind of the governance and sustainability engagement, which is important to distinguish. Smaller companies have started to pick up on that. I would say maybe this is very, very broad, but maybe about half of the top 100 companies are doing the engagements. I think there's so much room to improve there. And I think when it comes to voting, there's really one thing that in Switzerland is significantly different, I think, from Europe and the UK, and this is the compensation report. We've seen that it was much more distinct last year, but Swiss companies get a much higher against vote on their compensation report than their peers in Europe and the UK. And we asked last year in our survey, we asked the institutional investors, why is that? Why do you treat Swiss companies much more critical than the European peers? Number one was the amounts, the compensation amounts were just higher in Switzerland than they are in Germany, for example, or France. And the second reason, which is almost the same weight, was the pay for performance disclosure. It's just not good enough in Switzerland. So I think we're lagging behind a bit, the Europeans, but that's up to you to say that. But I think we're lagging a bit behind Europeans. But when we look this year, so I looked at the 20 compensation report votes with the highest level of against votes. And we looked amongst these 20 votes, 30% were also amongst the companies with the highest pay. So it's not really that high pay means that you automatically have high against votes. It's only 30% of these highest paying companies that are in there in this pool of highest votes. And 40% of these highest against votes company were actually companies paying below average compensation. So we had more compensation we had more companies in these highest 20 against votes than we had high paying ones. And that for me is really kind of an information to see that pay for performance really is the big issue, because those were probably the ones that had an issue in explaining of why they paid their salaries. And that was a bit of a difficult thing, but I thought it was an interesting observation.
Yeah, I think so to give you a sense, in the UK, average policy reports, average policy votes are above 95, 96%. Same on their remuneration report. France, the policy's around 90, and you get the reports about 87. Germany, I think the policy's around 92, and the reports are kind of close between 87 and 90, depending on the year. Here, for us, we think that you get actually a very strong policy perspective at about 92.5, but there's about a 7% fall off on the report. And when I look at that, again, it comes back to this practical view of why you do what you do. If you're not giving the disclosure, if the quantums are higher and you're not as detailed, you will get a lower score. But that being said, I worked with a French bank and a UK bank. The UK bank, really will pay a great deal, 2 to 3 times more if everything's successful. But the level of support they got in their policy was about 98%. Yet on the French bank, they had a great year. They got about 86.4%, but a lot of the difference was around the level of transparency. It wasn't about the quorum. And the other thing I'd say that is really important about the engagement and the European engagement is that the vote, is a serious thing that here. And there's an expectation of sophistication that corporates here have. In Switzerland, when we work with our clients here, the level of sophistication is real because the stakes are higher. Things are binding here. The board can't just say thank you for playing and do what they want to do. There are consequences. As Chris has said, if you don't listen to people, then there's a knock-on effect. And if things get really out of control, then an activist investor, for example, can start to say, the only choice I have after this engagement is to actively try to seek change to save my investment. So to me, I think generally, there's a lot of quality here. People know how to do it, they engage well, and when it does fall down, it's usually because they couldn't lobby enough internally to get to this the transparency they needed to sell it on the outside.
Mm-hmm. Great.
Yeah, no, that makes sense.
I think we have covered a couple of the bigger topics here. Back to the audience, are there any questions that you would like to raise on these issues? Yes.
If we talk about ESG,
So maybe just hang on a second. Will you get the mic? Just hang on for a sec. Yeah.
Hi. If we think of ESG, which is now a wave against from the anti-woke trend, and look at the ESG ratings, MSCI ESG, Sustainalytics, Morningstar, and ISS Corporate ESG rating. They are all based in the US. You don't have an answer as well. What's going to happen with them? Are they going to survive, or is it also part of the change? Maybe you don't know the answer, but
That's it. Yeah.
I mean, I've always, as you've maybe got it, there's an ongoing theme. I'm pretty practical with these situations, and what we've seen over the years, the subjects of the day change. An American company will have to adapt to the landscape they're facing, but nevertheless, there is a demand in other regions for this intelligence, and the source and sort of the model is held in the United States today. I think that my sense is always when I've talked to companies and talked to actors and that part of it, I said, well, you need something that is a measure that translates the so what factor of this in our context. Because things like basic financial things like operating profit, free cash flow, leverage levels, what are the things that really matter? And what I did see over time for these, at least in the practical application of the ratings in companies around their road to carbon neutrality, was that they started to use the guidance there in the same way that they were using the guidance overall, and the really talented ones were able to tie back in the fact that sustainability in whatever format is most appropriate to that company was part of their social license to operate over time, and it was a greater good. But I think in the United States, typically there'll be a bunch of lawyering up, figuring out how they can still do it, and if they have to offshore it and keep it, they probably would. I mean, I think that think about it this way. Today, even today, the United States could not rebuild a Saturn V rocket. Technology they had in 1960 because they forgot how to do it, they didn't keep it. European countries today and the companies know how to do ESG. They've worked extremely hard for the last 10 years. And I think that it would be a shame to give it up. And I think to a certain degree, the U.S. actors in there, they still really believe in these subjects, and they're going to have to find a way to get around their situation, you know. And
No, I would agree. I think it's more. I mean, I think it's the more fundamental questions behind these ESG ratings, and I think we've spoken about that before. Is in the sense that the CSRD provides investors with so much more transparency on sustainability topics. Before, a lot of investors had to rely on Sustainalytics, MSCI, you name it, to come up with some kind of rating. But that meant that all investors were using the same ratings, but they actually want to use their own rating because they kind of want to distinguish themselves from the other investor. And so what I would expect is, maybe a bit more difficulties in the US for them providers to actually get this data. But then in Europe, I would expect many investors trying to read out the CSRD reports from the European corporates and using the data in their own models. But that's kind of.
And I mean, one of the things we observed this year in the season was that a lot of our clients would ask, well, did you read my CSRD report? And the answer sadly was often no. There is a great expense to do these in-house, and if the market isn't using them, there might be other questions that have to be posed, but it is, there's a lot of valuable intelligence,
Yeah.
and in certain countries, they went all in early. I mean, in France, for example, it was all up and running since last year, and this was a huge effort. We'll have to see, but I think that, again, European groups tend to value stakeholders a bit more, and those challenges haven't disappeared.
Yeah. And on top of that, I would see that if you're a company and you have invested a lot in sustainability, well, you have all this new data, you may actually have found that this data is actually pretty good because it can help you to save water, produce more efficient, whatever, right? So this data could be actually also a game changer for your business, and then there's no incentive for you to get rid of that. So I really think we may see a bit more of a divergence between these companies for which sustainability really has been or become a very strategic pillars, so they really want to stick to that, and those companies that have used ESG more as because they have to. For these companies that only do sustainability because they have to, they probably will not spend so much resources anymore in the future, as long as they don't have to, because with the stop clock and everything. But yeah, I think the topic will definitely be around.
Great. Are there any other questions from the audience? If not, I do still would like to know, just looking ahead, I don't know if you would dare to say something about the next year's AGM session or not season or not. Would you, if you can say no, but do you see any trends or things that you would expect to stay?
Yeah, I do. So I tend to think about these subjects a lot because I do believe it's more of how will it evolve. So to me, whatever E&S means, and it still is a great important thing, the reality is next year it's all going to be about G when it comes to voting. So you have to get it right. You have to understand what the policies are at your investors, first and foremost, what the policies are of your proxies, and then from there figure out, in relation to the goals we have and what we think is essential to us, where do we have to talk, who do we have to talk with, what do we have to talk about, how do we have to change to get to yes. I think that if you had poor scores this year, and whether it's not necessarily a poor score to have less than 80%, okay, but in their world it really matters. And what it means is that if you get a poor score and you don't address it publicly, with the board met, the committee met, we met 3 times, we talked about it, we talked to 15% of the investors, this was the feedback, this is the decision, essentially 2 to 3 paragraphs in your annual. If you don't do that work, you're going to get singled out and you're going to get a lot of negative votes. And I'd say the other thing is that on remuneration, pay for performance is going to be key. If your company is not performing and your corporate officers are making 100%, bonus, 100% of their salary in bonus, and your shareholders are hurting, they're not going to tolerate it. they're going to push back really hard, and they're going to start to call people out. That's one thing that we saw this year, and I just think that there is a growing frustration from investors who have seen, their convictions around E and S go poof because of one individual's worldview, that they have to exist, and where they're going to exist is by demonstrating their governance bona fides. And I just think these subjects are not the hardest, but if you show mastery and you show conviction about where you're making an exception, you'll probably get through. But to me, that's kind of how I see it going.
Yeah, yeah. No, I tend to agree. I think the focus was already much more on governance this year. I think it will accelerate next year. And I really think, if you see that already this year you had an issue with an election or whatever, really you have to tell your board this is not going to go away. It's going to get worse, and it's going to hurt them individually if they're, chairing a committee or if they're chairing the board, and it goes against their reputation because they will be the ones that actually get the high votes next year. Now, as for topics next year, I also think it's governance. Maybe sustainability will come back a bit. I don't expect, given the current situation with, with the taxes, with the geopolitics, I think boards are, they have plenty of stuff on their table, so they will not look for any other topics. AI, maybe, but you have to keep your business running first and foremost.
And I think what you've just mentioned, demonstrating your storytelling about your board's ability to manage various systemic risks is key, because there are a lot of them, and currently it seems to be a new brand of crazy every 72 hours.
Yeah, and I mean, in the end, you need to have your business in control, and that's we'll use a lot of the resources of the board for the next year. So, and I think also for shareholders. I mean, this year for shareholders, it was a big thing. Suddenly you had this DEI is dead. That came kind of very close to the start of the US season. We started the season here. So I think there's also still a lot that shareholders will have to digest from this season, and I don't expect that there's really a lot of new things popping up, actually. There's just not the time for that. And maybe we'll do have some time next season to digest a bit what we've done in sustainability the last 5 to 6 years, right? We've basically run without looking back ever, and maybe now we have some time this fall to reconsider and really kind of see what maybe should be more focused on and whatnot.
Yeah, and when you can tie the progress in the E and the S to the delivery of your strategy, it helps. And I think that's one observation I had in the run up to the ESG movement was I was sort of, this is all neat, but like if you can't hit your numbers, you're in trouble.
No, exactly. Yeah.
Now, my last question is, speaking of these, you spoke of the crazies. I just like to ask you, David, as an American, French citizen, you bridge the big pond.
Yeah.
What is your take on the current
okay.
situation?
Yeah, it's a nice question. Something I think I wake up with. For years I shut the TV off and didn't listen, and then this happened. My sense is that people are talking about a movement around the pendulum, that it's just swinging the other way. Be careful about that. This is not about just word salad. This is about democracy, and this is about the rule of law, the fair playing fields, markets that aren't corrupt. And my sense has been that it's more fragile than we think. And it's very hard right now to have much of a say on these points. And when I was organizing this conference, I thought it was a really interesting thing, because I didn't want to get on. I wanted to try to contribute something. So I talked to a lot of people who had a lot more gravitas than I have. And there's sort of what they think and what they're allowed to say. And I had one example where he said, "What do you want me to ask that guy?" And then I sort of described. He said, "No, really quick. What do you want?" I said, "What's been the reaction to Trump's anti-woke policy? Have you changed your voting?" And the guy wrote right back to my friend, who's extremely connected and powerful in this space, and said, "There's been no change." So that's changed. A minute later, he came back on a different thread, said, when you want to talk to me, just call me. And it's that kind of stuff. And then I won't get into the whole societal issues or, you know, I don't know. It's just, you can't keep up with it anymore. So we'll just have to see, but I think that a lot will play out in the next 2 years because there are no checks and balances right now. And I think that from a market perspective, which is really problematic, is there seems to be a certain degree of payola or corruption. No, I'm not saying anyone is corrupt or anything, but it's just a different vibe. And too many powerful people ponied up to be close to the situation for fear that if they disagreed, they'd be sanctioned. And that is different. And that's not good. You know, and then I don't see where the market prevails, but you know, once the bonds started to turn the other way, that was the first thing. And I don't know, I just think buckle up tight, but you know, we've talked about tariffs, but we haven't talked about Section 899 of the big beautiful bill, which is going to create these super taxes around the world. And there are no voices saying, you know, global economy mattered. You know, international trade was a good thing. The fact that I'm an American and a French person talking to a bunch of Swiss people did not happen 100 years ago.
Yeah.
And these are all good things, and these voices aren't being heard. And I think there's just a general, like, read books. You know, have a critical thought. Don't just buy in. And I think that kind of basic stuff, like you learn as a kid, you know, is valuable still. And I don't know, I mean, I'm heartbroken. I'm absolutely heartbroken, and I don't know how it ends. But I'm not at all as this is just a pendulum. I'm like, you better fasten your seatbelt, because if an American just can get arrested in the street by somebody who's masked with no warrant and and there are U.S. Marines on the ground of Los Angeles with guns, this is just insane. This does not happen in the United States. So I hope I'm wrong. I really do. But I think it's going to be, you know, take a deep breath.
But would you, if you don't mind, you said that many of these people, personally, they still have a different opinion than they actually professionally have to carry out.
Yeah.
Isn't that kind of maybe a straw of hope in the sense that if it changed on the top, then they may actually come back with their personal views again?
Yeah, I think so. I think most people don't agree with any of it.
Yeah.
But
Okay.
they didn't want to believe that there was a Project 25.
Yeah, that's true.
They didn't, I mean, I don't know about you guys, but like I mean, the United States and NATO, I mean, you talk about soft power. Okay, this is what I would say. The U.S. benefited from 1941 to 2005 of this incredible soft power. And yeah, NATO costs a lot of money. But you know what? It's the only international body that ever worked. And it's worth so much more. And friends matter. People, you know, I mean, it's just everything that I thought democracy is about is not happening, and it's being stamped upon, and it never had to happen. And I don't know how you get it back if you wreck it. You know, I mean, think of the nice heirloom you have in the house. You didn't mean for the child to knock it over. When it's broken, you're just going to always know, like, I glued it back together, but it's broken. You know, and those are kind of things I think we have to just be vigilant. And I think that, you know, so it's, you know, it's wait and see. But I think, you know, if you need vibrant economies, I mean, just think about like what happened in the spring. Like, you know, we were shooting ourselves in the legs on tariffs, and no one was saying, you know what about David Ricardo? What about Adam Smith? These are not new ideas. This doesn't work. And, you know, and then people who are in power who aren't really challenged keep spouting out stuff that you would have failed the macroeconomics test in the first year of college if you said that stuff. You know, so those are the kind of things that, and you know, I mean, you know, burning money on the stock market. I mean, that's crazy. And this, you know, the Greek, and it's always, I don't know, it's just.
Well, on that note, thank you both for your insights from the nitty-gritty of AGM policies and engagement with shareholders and proxies to NATO. Thanks a lot.
Thank you.
Thank you. Thanks for being here.
Thank you. It was a pleasure.